What was the impact of capital flight on Latin American investment? Imagine watching a country lose a large chunk of its savings overnight. That's what happened during the Latin American debt crisis of the 1980s. Countries in Latin America faced a huge problem with money leaving their borders. This outflow, called capital flight, was driven by economic worries, political instability, and policies that made investors nervous. Between the early 1970s and late 1980s, Latin America saw about $151 billion leave the region. That was roughly 43% of all the external debt they had accumulated during that time. This massive outflow of money made it hard for Latin American countries to fund their own growth. Instead of using their resources to build roads, factories, or schools, much of the money was moved abroad by wealthy individuals and big companies. This meant less money was available for local investment, which slowed down economic progress. When capital flight happens, governments also lose a lot of tax revenue because some assets are hidden or unreported. This reduces the funds they have to spend on public services like health, education, and infrastructure. The wealthiest people often benefit from capital flight because they can move their assets easily, while the average citizen faces fewer opportunities for economic improvement. During the debt crisis, countries struggled to pay back their loans while losing money at the same time. This created a vicious cycle where less investment meant slower growth, making it even harder to pay debts, which then pushed more money to leave the country. Governments tried to control this outflow with rules on currency exchange and restrictions on moving money across borders. But these measures often didn't work well and sometimes caused more problems. Even after the 1990s, capital flight remained a challenge. It could trigger financial instability, even when the economy was doing okay. Overall, the large-scale movement of money out of Latin America drained vital resources needed for growth. It deepened the economic crises of the 1980s and kept the region from bouncing back quickly. Understanding how capital flight affected investment helps us see why Latin America faced such tough economic times during that period.